All right. See, we are live on all the socials, live in person. Let's get started. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and I'm joined with Doug Hagren today. Hey, Doug.
Hey there, Kirk. It is not Doug Hagren. It is Douglas Hagren,
Is that
Trophy Husband Esquire.
is that that's your stage name, Douglas.
That,
Douglas.
that, that is Douglas Hagren, Trophy Hunter Esquire. I just want to make sure. I don't really care about the Doug or Douglas. Just we need to make sure that we are clear on the fact that I am Trophy Husband. Okay.
Nice. I like it. I
Thank
like it. I do not have one of those shirts. Apparently, I'm not qualified.
And I'm not offended by being called the Trophy Husband. No, my wife can wear me on her hip all she'd like. So.
Good times. Well, actually, Doug has some other great news. Doug, you want to share your news here?
I do, and it is with great honor that I can say that I have officially hit my midlife. I don't know if we're going to call it midlife crisis, but I think we might have talked about this, that I am now joining the 50-year-old club. I have crossed over, and with it, I don't know why they call it the midlife crisis, because the average age isn't 100. So I passed midlife quite a long time ago. I think it's probably closer, I don't know, based on life expectancy. Like my midlife was like 38, 39. But hey, every day is beautiful borrowed time. But look what just came in the mail there, Kirk. Yes,
ARP.
card enclosed. But this is the best part, is I haven't looked at it yet. I'm just going to take it out of here and open it up. AARP says last chance to join at the 2024 rates right now. I got to mail this in by the 27th to join the group of golden. As in Ohio, where I grew up, we used to have something where you can get discounts everywhere. It was called the Golden Buckeye Card. So I'm going to have to sign up for that as well. But this is the best part. This is why I got to jump on this, Kirk, because it says choose your term. I can do a year for 16, 3 years for 43, 5 years for 63. But most importantly, and this is really good, it's going to sway me, free pickleball set.
Nice. Now you're officially
your membership.
Pickleball. And I know how much you love pickleball, Doug.
Yo, I love pickleball. Next week, I might wear my other shirt, and I know it might offend a few people here. I'm a tennis player. I stopped playing wiffle ball when I learned how to throw real baseball, and then I learned tennis. Well, I don't know why I'd go back to wiffle ball. I know it's really popular, but if that's just – there's a running joke out there that pickleball is basically okay boomer, right? It's like, it's the boomers are taking over. Nothing screams it more than free pickleball set for turning 50. It cracks me up. Anyway.
Well, just for reference, I don't think wiffle ball is bad. I think wiffle ball is kind of cool, even though
it's a
I
lot
play
of
baseball.
Fun. It's a lot of fun. It's great for playing. It's great for playing in your yard and your street with the kids. In fact, I mean, that's, people don't know, that's where pickleball started. Pickleball was basically taking ping pong paddles and a wiffle ball and knocking them around on a court on their driveway or in their yard. And the last bit of useless information, that where do they come up with pickleball? Because it's certainly not a sour, sport, although it's making, some people would say I've got salty tears and, I sound a little bit sour. But pickleball was actually named after their dog Pickles.
Well, you missed an important ingredient in the invention of the game, Doug. Is that is usually alcohol. Alcohol is usually involved in making up games like that. So
absolutely,
a lot of alcohol. I came up with some great games when alcohol is included, I'll tell you. But I actually came up with a great game in high school, which was not included in that game. But yeah, it never caught on because it was just like 5 of us, and no one else. It's not like hacky sack, which everybody kind of did, but. Anyway,
only those following the Grateful Dead and Fish. That tells me a little bit more about you, Kirk.
I do not follow either one of those, so that's I'm good with that. I'm not apologizing. Anyway, cool. So we have we've had another interesting week this week. The markets are up this week. Apparently, they decided that it's okay to go back in the water, or at least the S&P 500. Every market's kind of a little bit different, but we're in this weird period where we have a president elect Trump will be inaugurated next week, which would
No,
be
no, I need to
next.
correct you.
It's not
He's
next week.
already been inaugurated. He's been president for a month, according to all the people complaining about what the president has already done.
Oh yeah. I think yeah. I saw Gavin Newsom try to place blame on Trump, even though he's not even president yet. So I was like, yeah, actually, Gavin, you're the governor. And you know, I have to state this, and I love picking on California because it's such a shit show. But I have to state this: when you're governor, the buck stops there. And what Gavin Newsom is good at is double talk and being a politician. And he's just he's just a slick used car salesman. But I look at the guy clearly made mistakes. I mean, a good leader admits to their mistakes. I mean, let's be honest. Most politicians are not good leaders. I'd say almost all of them. But a good leader will admit their mistakes. They'll say, "I messed up. Here's where I messed up. Here's how I'm going to do better." It's that simple. You want a template? Look at Steve Jobs. He had one of the original templates. Yeah, we made a mistake. We're sorry. He didn't say we're sorry. He said we made a mistake. Everybody makes mistakes. Here's how we're going to do better. When Joe Rogan got called out for his during COVID, and people were yelling, screaming, "You're doing this." What did he say? "I'm sorry. I made a mistake. Other people make mistakes too. Here's how I'm going to fix it." Done. Right? That's a leadership role. What does Gavin Newsom do? Well, people on my team weren't prepared. People, I didn't have a lot of people. I'm asking people. They're not giving me good answers. You know what, Gavin? It's your team. You picked them. It's your fault. You're the leader. Take it on the chin. I think this guy's political career is over, and I think it should be. I mean, he's just a wet paper bag, and I think very poorly of him. Now, that being said, I think he's from the former generation of politicians, like the boomer generation, which he's not a boomer, but it's kind of like we're just going to talk our way out of it. And we have this new generation of leaders on both sides that are taking things a little differently. They're not the slick salespeople. Now they are slick, but that's not their thing. I think people are just sick of that. I think people are sick of the slick salesmen on either side, and I think that's why Trump got elected. People were just done with the status quo. But we're not here to talk about politics. I just find it interesting because the California wildfire incident. I was talking to a few people since last week, and it's really fascinating. It's obviously horrible on many levels. So let's move past that before I get hate. But it's really interesting on many levels because if you think about it, here's the state which has a lot of problems. Obviously, one of the problems is insurance companies bailed last year. Insurance companies just pulled out of the state. So what does the state do? Well, they have this fair insurance, the FAIR plan, much like Massachusetts. So Massachusetts has something similar. Insurance companies pulled out like 12, 15 years ago on the coastline. So we're not insuring your coastline homes. So what does Mass do? Mass pulls out they have a Mass, I forget what it's called, but they have a Massachusetts insurance policy where if you can't get it through an insurance company, you get it through the Mass company. Great. I mean, it solves the problem. Now, I don't worry about Mass because if Mass wants to be an insurance company, that's fine. We don't have wildfires. We have a hurricane that comes once every 100 years. I'm good with that. I feel okay with that kind of risk, and they do too, apparently. California, they've got a big problem. They got wildfires, and not only is it going to take six years plus to rebuild through all the permitting process, but also they don't have the money to pay people. Like there's I don't know how much. It's like some ridiculous number, like $1 trillion of damage. That may be too high. It may be stretching it, but it's a ridiculous amount of damage that's been done that you're going to have to pay people. Like, where's that in the budget? So I think California's done as a state. I think the political class over there is done. I unfortunately, I think too many people over there have Stockholm syndrome, where they're still going to vote for the same people that put them in the mess because that's what's been going on for decades. I mean, look at Canada. I think they revoted in Trudeau after a really bad first run at it. They did it again. So I think, to me, I think there's just a lot of uninformed people that just aren't paying attention, and they just don't understand how bad politicians really are. And it's all of them. And I don't mean this to be politically biased because I know I'm picking on the Dem side because it's California, but both sides do it, and both sides are responsible. And I think we need a better class of leader and politician. So we'll see. Hopefully that happens. I do want to touch on a few things here because there's a few frameworks. This is gonna be a chart show. We're gonna do a lot of charts today. So here's one I wanted to share, and Doug and I are going to kind of go back and forth here with charts. But so I saw this online and I thought it was brilliant. And here's why. Now it's using Bitcoin, which is kind of it's the poster child here in the example. But you can use it for anything. Use it for stocks. Use it for gold, your house, whatever, instead of Bitcoin. But a lot of people see Bitcoin's price going through the roof, right? We're close to 100,000 a coin. 2017, it was like 1,000, 2,000, something really low. I mean, it's gone up a lot in the last, 8 years. So people look at that and they say, oh, well, obviously the price is going through the roof. It's great. It's a great investment. Where if you, and this is what is hard for people to understand. What a lot of people don't understand is that's actually not what's happening. What's happening is Bitcoin is having the same value. You have the same purchasing power. But what's really happening is the dollar is declining in value, in purchasing power. Now, this is not meant to be a one-to-one. It's an example. It's illustrative. If you look at the last 10 years, obviously the dollar has not gone down like 10 to 1, but you get the point. So gold, if you look at historically gold, you look at real estate historically, this actually does hold true. With exception of the 2008 period for real estate, it was pretty much a flat line for like a few hundred years. So real estate is a great example of this. So what's happened is, if you look back 100 years, you say, oh, well, real estate was cheap. You could get a house for $1,000. Now it's like $1 million. Well, what actually happened was the inflation rate of real estate, the prices, the price tag that you see goes higher because you are spending dollars. Now, this is I'm going to walk through this frame. When you buy something, I have $1. So let's say I'm going to take this Zim dollar, right? I'm holding it in my hand. I'm going to go buy a loaf of bread with this 200 million Zim dollars, which actually I probably need a stack of these for a loaf of bread. But anyway, so I'm going to go buy a loaf of bread for this, okay? I'm going to exchange let's call it $10. I'm going to exchange my $10 for a loaf of bread. And what that means is I have a greater need for bread than this $10. So the $10 is that this loaf of bread is worth $10 for me. Because if it wasn't, I would go buy something else, right? So today, my $10 is going to go buy that loaf of bread. Now, let's fast forward 20 years from now. This $10 is no longer going to buy the same loaf of bread. The loaf of bread is going to now cost, let's say, $20, right? So $20. So now I need 2 of these to buy 2 loaves of bread. Did the loaf of bread go up? No. Now the price tag went up, but that's not what's actually happening. What's actually happening is the dollar is now worth less. So the better way to look at this is the loaf of bread still costs $10, but now my $10 is actually worth 5. Now it still says 10 on it, but it's actually worth 5. So what's happening is the dollar is declining in purchasing power. So if you put $100, 100 years ago, you put $100 in a safe vault and you pulled it out now, 100 years ago, that you would have been like being a millionaire. Nowadays, that's just like filling up the tank of gas. It's a very different perspective. It's not that the numbers changed, the numbers stayed the same. What happened is inflation eroded the purchasing power of this dollar. So what most people see is numbers on their bank account. Oh, look, I have $1,000 in my bank account. What can I buy with it? Well, today you can buy A, B, C, and D. If you wait 10 years, you can probably only buy A, because all the rest of the things are more expensive. So what's actually happening, even though the numbers on your bank stay the same, the value of what that buys goes up, which means you don't have enough to buy it. So I think this is a framework that messes with a lot of people's heads, and a lot of people struggle with this, but you need to be thinking in this way. And it also works the other way, mind you. Now, I think any living person has, I think not every living person, but most living people have only lived in an inflationary environment. They've never lived in an environment where deflation was the norm. It happened. There were periods of time prior to the Federal Reserve where we had inflation, deflation every other year. It would spike. We had huge inflation, huge deflation. It was just normal. Now we have this slow, consistent inflation over time. Now the idea is to basically minimize the volatility, so it makes it easier for people to make good decisions. Which I get. It makes sense. I know people don't like that answer, but it makes sense, right? There is some validity to it, whether you like it or not. However, the problem is that if you look at inflation over that time, right, it's eroding your money. But if you look at deflation, it's actually making your money more valuable. Here's an example. Look at the Japanese stock market in 1990, and you'll realize from 1990 up until 2023, I think it was. I have to go look at the actual date, but somewhere in the last 5 years, where the Japanese stock market bottomed out, it basically went down for approximately 30 years. I think it was 32, 33 years was the number. It went down for 30 plus years. Can you imagine investing in the stock market and losing money every year for 32 years? We can't, because we haven't seen it. But that is an asset deflation. The asset is the stock market, the Japanese stock market, Nikkei. The asset price has declined over 30 years, which means if you had just held on to your cash, you would have done fine. Now, there's other issues here. I'm just saying in comparison, right? Because you're taking the Japanese yen and exchanging it for a share of the index. So you're always in any asset. If you're looking at the price of gold, if you're looking at the price of oil, if you're looking at the price of Apple, Nvidia, if you're looking at the price of housing, whatever it is always what they call a cross. Now, this is what happens in currency trading. You have the euro and you have the dollar. Well, I have dollars. I want to buy euros. So what's the exchange rate? Well, that's the exchange rate. Now I buy euros. And now if I have euros and I want to buy the yen, I go buy the yen. And there's an exchange rate for that. There's always an exchange rate within currencies. They have different valuations and they fluctuate. They go back and forth. The same applies for other assets. I have dollars. They're worth whatever, $1. I want to buy $1 worth of gold. Well, right now, an ounce of gold costs whatever it is, 2,600. Is that what it is? I don't even know. I'm speculating at the moment. It's my gold friends are going to kill me. $2,750 as of today. So $2,750, I can buy an ounce of gold. Now, if I look back 20 years ago, that was 300, 500. It was a lot less. Back in the early 2000s, I think it was like 99. I think it was the bottom of the gold market. So somewhere around there. Anyway, so it's come up a lot. And if we had exchanged dollars for gold then, that would have been a good deal, right? If you exchange them now, it's a lot more. So there's always an exchange, right? No matter when you do it, and both prices fluctuate, and you're trying to optimize the exchange, right? So when gold is going up, we think, oh, we want to buy something that's going up. Well, what's really happening is the dollar is going down. It's devaluing in the price of gold, because the purchasing power of gold has not changed in thousands of years. They go back and they say an ounce of gold bought a gentleman's suit in London. An ounce of gold buys a gentleman's suit now in the U.S. It bought a gentleman's suit or a toga in the Roman Empire. So it hasn't changed in its purchasing power. It has always bought the same amount of stuff and the same type and quality of stuff, which changes the purchasing power of everything else you're using to compare it to gold. So that's the frame I want people to remember. So if you look at deflation, let's say we have deflation. I'm not saying we are, but let's say we do. We have deflation. That means your dollars are worth more. What that'll mean is the cost of everything else is going down, because right now the US dollar is going up in comparison to other currencies. So let's say the US dollar keeps appreciating, and then asset prices, the stock market, gold start to go down. Well, that means we have deflation. The dollar's worth more and is increasing in value. Those are two frames you need to understand. Here's why, and here's the conclusion of this, and then we're going to let Doug share a chart. The conclusion is this: when you have the stock market decline 50%, like it did in 2008, it declined close to 60%, 58 and change, but let's say 50 to make the numbers easy. If the stock market declines 50%, you lose half your stuff. But if you were in cash, What's the performance of your cash? What do you think, Doug? What's the performance of your cash if the stock market goes down 50% and you don't own that, you own the cash?
Oh, well, double that, 100%.
Exactly. Most people don't realize that, right? So if you buy a stock today at $100 and you have $100, right? That's the price. Let's say the stock market goes down 50%, so now that stock is only at $50. Well, now my $100 has stayed the same. I can buy twice as many of those stocks, which means that my dollar has appreciated 100% because I can buy twice as much, right? So it's doubled in value. Now, most people don't think this way. Most people think, well, the market dropped. No, your cash went up, which means if you're in cash when the market crashes, your cash went through the roof in performance. No, people don't look at that. They look at their statement and say, well, my cash is still the same amount. Yeah, but now you can buy twice as many shares of whatever you want. So the value of cash, and I have to rip on Ray Dalio, who is a very smart guy. So I'm picking my fights here, but Ray Dalio says cash is trash. That's his phrase. I say cash is king, because if you have cash when no one else does, you can buy whatever you want and you can name your price. 2010, if you have a pile of cash, you named your price in real estate, buy whatever you want. No one had any. That's the reality. I think that's how you have to start thinking about things, is what is the alternative to what you're doing? Because if you're just saying put it all in red and let's spin the wheel and see what happens, you can lose a lot of money. Now, I hope the incoming administration does what they say they're going to do and all that good stuff, but the markets are priced to perfection. Any little slip up could cause the markets to go down. I'm optimistic, but I'm also realistic in the sense that I think the opportunity set for this year and next year are going to be slim. And if Trump could do something, I give him more credit than I'm already giving him, because I don't know that anybody can push us through the situation we're in now to keep going to all-time highs and growth of 10, 20, 30%. I just don't see it in the markets. I think we're overpriced. I think the market needs to reset a little bit and rebalance itself. And then I think we could keep going, but I think we're way over our skis at this point in the market. So, Doug, what's on your chart list here?
Well, the first thing I'm going to say, Kirk, is I have to call you out. That Bitcoin versus dollar is a chart crime. I mean, I don't know how far that went back. I don't have any metrics on that whatsoever.
There's no numbers.
Stop pushing chart crimes, Kirk.
It's illustrative purposes only. I should have put that on the illustrative purposes only. Chart crime.
It may be the worst chart crime we've ever shown on this show. I just need to throw that out there.
I wasn't trying, though. At least I didn't put numbers and say, "Oh, look at this, Bitcoin to the moon."
Exactly. Well, since you just talked about where the markets were, I think it's a good time if you want to pull up the chart of the 151 years of S&P 500 returns. I think it's a good time to take a little bit of a note, because what we talked about last week a little bit, I went into a conversation about the it's in your list of charts that you posted like 2 or 3 posts ago with all the different charts.
Right. Okay.
But what we talked about was we talked about ordinary income, and is your income ordinary? We went through that. Well, I think, you just talked about where you think that the value of the markets are. And I think it's a good time to talk about, again, what is ordinary. And if we take a look at that, if we take a look at the spreads, right? So from negative 50% returns on up to 50% returns. Okay. Now 50, it's incredibly rare to have anything at that high end and the low end of either one. 1931 was between 40 and 50% decline. Interestingly enough, even though we were in the middle of what happened during the 30s, Kirk?
Great Depression.
Great Depression. So how many would you say that it seems to be a general belief that the 30s were an absolute disaster the whole time? Pretty much.
Pretty much. Right?
Yeah. But there's something to really understand about what we call secular and cyclical. Okay. And a lot of people do not understand those terms. Secular terms are long-term trends. Cyclical trends are short-term trends. And so even if you're in a secular bull or bear market, you can have, anomalies that occur in between that, which are cyclical. So even though 1931, we saw that negative 50, negative 40% decline, if you actually look, interestingly enough, the two of the best returns you'll ever get in the market happened during the same period, 1933 and 1935, 40 to 50% returns during that. Now, flip around and you've got 1937 all of a sudden being down between 30 and 40%, right along with 2008. But what I really wanted to point out here is just how skewed things have become. If we get to that 30 to 40% metric, we can see that, wow, how many of those dates were in the 90s when we knew, we were looking back, that we were in the bull run. 1997, 1995 were both 30 to 40%. 1975, in the thick of all of the Vietnam and the oil embargo and some of the worst arguable stagflation years that that we've had, 1975 actually was a fantastic year. And before that, we didn't, basically 50s, 40s, handful of times. But look at this here, 20 to 30%, Kirk. 2021, 20 to 30%. 2023, 20 to 30%. 2024, 20 to 30%. Now let's add in 2020, 10 to 20%. 2017, 10 to 20%. 2016, 0 to 10%. If anybody thinks that this, that there's they don't see a pattern here, and how much, if we look at the way those numbers work, since basically 2000, the number of times that we have hit in the 0 to 30% range, but especially over the last 3 to 5 years, is outside of the norm of any spread in history. And so I think, now you can see here a quote from Morgan Stanley that says, well, 2023 to 2024, pretty much textbook for the first 2 years of a bull market. I see no reason to believe the third year, 2025, won't be consistent as well. So they are looking at everything. They're actually looking at this as the start of a secular bull market, which is incredible considering that we've arguably been in a bull market for how long, Kirk? Now, granted, we know 2020 was COVID, and that was a massive reset that created a tremendous amount of cash in the markets. But we also have Goldman Sachs saying we've got positive but moderate earnings growth. We expect slower index returns that have been experienced in recent months. Over the course of 2025, we see forecast total returns of approximately 10%. So still extremely bullish out there. But at the same time, you look at the numbers and you look at the pattern. There's a term called reversion to the mean. And if you look at the number of times since 2020, especially, that we have hit in this 10 to 30% range, it is not unexpected to see that we are due for some sort of significant correction. We saw a little bit of that in 2022, but a lot of that was, coming back from the Fed really giving us, inconsistent outlooks and projections on what they're going to do with interest rates. And what have we said time and time again, Kirk? The markets don't like uncertainty, right? So 2022, there was a tremendous amount of uncertainty there. 2020 was a tremendous amount of uncertainty there because of COVID. And a lot of people projected in 2020 that we should see a pullback anyway. COVID just exacerbated that. But 2021, 2020, 23, 2024, heck, even 2019 was 30 to 40%. So there's been a tremendous skewing going back to the late 2000s that have really pushed a lot of these returns into what is well above the average in terms of double-digit returns. So people are starting to get very used to that, and I think that's something, to me, bodes caution. Okay, it doesn't necessarily translate to something that is in line with what we would normally see historically. I don't know if you have any thoughts on that since this chart's still up.
Yeah, I just took the chart down. Yeah, I mean, I think what's interesting is I did some data analysis on this a while ago, and just looking at annualized returns, and what I found was about 70% of the time the market performs better than plus 10% or worse than negative 10%. So the period of plus or basically negative 10% upwards, the middle, like between the plus and minus, that's only 30% of the time. And what's fascinating to me is that it's so lopsided with the returns, and people don't think it that way. They just think, oh, it's always going up. But then, of course, when it goes down really hard. Um, Very rarely will it be in the middle. I think one year was like 0% return. It was like slightly positive. So maybe that's, I'm curious if it was zero, where that would fall, but I think it was slightly one direction. But anyway, the point being is like, you need to understand that there's a bullish bias in the markets. We are overvalued. I'm going to share actually two quick charts. And one of which is the CAPE ratio, which is what a lot of people use to judge valuations. The Shiller CAPE ratio is as it's typically known. And so what it is, if you look back 125 years, 24 years, I think it says in this chart, then right now, as of, actually, this is an old chart. This is of 2021. So I don't have the number offhand, but I believe, to my understanding, we are the second most expensive market that we've ever had. The most expensive being December '99 with a 44 CAPE ratio, the average being right around 17. I will argue that things have kind of changed in the 2000s, where it appears as if we may continuously be overvalued for longer, even if it falls, right? Even if, let's say it's maybe Doug can pull this up so I can speak.
Yeah, I'm working on
it. Okay, yeah, thanks. So even if it's 40, right? And I don't know what it is offhand, but let's say it's 40, and it cuts in half. That's still 20. That's still expensive, even if it gets cut in half. And it's hard to imagine it's going to get cut in half unless something bad happens. And even then, that's on the higher side of average. So it means that if you're looking at this, you're really looking at, it's more than cut in half. You're looking at a 60% drop to get to below that level. Now, I don't know that we'll ever hit that, because if you look at 2008, I think at the low it went down to like 12, which, can you imagine like the mess the world was in, and it was a 12 Shiller PE when the average was like 17. Like, that's crazy. If you look back in the 80s, it went down to like 5. In the early 20s, it went down a lot lower than that. So if you look at it and say, well, the worst of times it was like 5 or 3, and now we're at like 40. I'm not suggesting we're going to get back to the 5, because I think some really bad stuff has to happen to get there. But you have to keep in mind that what that would mean is a huge change in asset prices that no one's prepared for. I think there's just too much money floating around for that to happen. I think that's part of the problem. I think it's also part of the problem that you have everybody's dumping their money into indexes, which pushes the prices up. So there's this concept that's being floated around there called the relentless bid. And I talked about this in one of the interviews, but I'll share it again, and I'll hand it back over to Doug. The concept of the relentless bid is something I've been struggling with for like the last few years, and it's this: is that you can look at the markets and say, this is reality, this is what should happen, right? You can look at it and say, well, here's what should happen. The market should drop because they're too expensive. Well, that's a fool's errand, because that's a recipe for failure. It doesn't work that way. If you're a fundamental analyst, that's not how it works. You can keep going. You can get much, much, much more expensive than you are now, and people are okay with that. It's a bad idea, but it's just the way it works. So you can't really go on valuation. But if you're looking at, I just lost my train of thought. Where was I going? Just trying to keep too many ideas in my head. Where was I going there, Doug, with that?
I don't know, but while you're thinking of, I'll just come back to the CAPE ratio. So I've got some charts that as of late December, it hit the second highest point. Let's see, the CAPE ratio was at 38.1 on November 16th. As of December 17th, it hit the second highest all time. The highest was the .com bubble. And I did post in there a picture if you want to share it, Kirk. Your background just looks like it died on you. And I don't know what's going on. I've had that happen before. But I did show a chart that shows all of the points of the CAPE ratio and basically where those numbers are and kind of what that means in terms of forward returns. And they give 2018 as an example on that. So, if you want to pull that up, there's a couple things there that might help to provide some context.
All right, well, give me a second. Which one are we pulling up, Doug?
They're the last things I posted. So
okay, yeah, let me pull this up. Cyclical, this one.
Yeah, so that's where we were. That's where we were as of November 15th. There's another one I posted right before that kind of shows the overall data points that have been plugged in at any time on the CAPE ratio.
Let me pull that up. Yeah, sorry.
Close that out. Nope, go back up. Go up one more. We'll work through this, folks. So
yeah, sorry, the computer seems to have not liked me today. Here we go.
Yeah, there we are. I thought that would help give you some context of kind of just how the relations work between where that CAPE index is and forward returns. So,
okay, cool. All right, so we're gonna let me share a different chart, and so you guys don't have to look at my green screen here.
And by the way, Kirk, while you're pulling that up, what was the dollars that you had that were the valuable dollars you were showing again?
Oh, the Zim dollars, Zim notes.
Yes.
Yeah, I've got
I wanted to share with you that I'm going to trade you. I have the trophy husband and I've got a note here for $1 billion, and I'm gonna trade you in that because I think that this is equally valuable, and I think this is the future currency. Down with Bitcoin. Trophy husband notes are the future.
I think yours is probably worth more than this because this is worthless. So
at least I can recycle the paper. There's some value there. Then there's more paper in mine.
Yeah, I mean, eBay might give me a little more, but certainly no store would. All right. So anyway, so we're going to share this. So we've talked a lot about how the U.S. has become increasingly concentrated with the top holdings in the S&P 500. And here's the thing. This has become a larger and larger problem over the last 15, 20 years, where the larger stocks keep getting larger. Oh, I remember we were talking about the relentless bid. So,
yep.
Yeah. So the relentless bid is this. Here's a theory behind it. You have a huge amount of money going into the market, right? So every year, money's just plowing into the market, and I'm actually gonna pull this up because my computer crashed a few things at the same time, which is why you're looking at my green screen. All right, here it is. So if you look at the, and I'm not sharing this, I'm just going to walk you through it. So if you look at the, let's see, where is it here? Okay. Currently, there is, as of 2010, there was $258 billion going into index funds. As of now, this year, $600 billion is going into index funds each year. And in 2013, there were 63 million participants investing in 401k plans, and now there's 80 million people. So now more than 15 trillion in assets are linked to the performance of the S&P 500. Now, what does that mean? That means that even if the markets go down, you have people buying more. People just keep buying. It's like the bubble that just keeps blowing up, right? It's like the tulip bubble. People find ways to invest in tulips. They just kept doing it until people realized, okay, I'm not going to buy that tulip. I don't have any more money. And then just all crashed. So at some point that happens. But at this point, I don't know when that is because there's a huge amount of cash flowing into the market because of the amount of money being printed by the Fed and amongst other things. But the point is you've got this huge amount of money flowing in indexes. What are the biggest securities in the index? Well, there's 7 of them, Mag 7 they call them. And they get most of the money, right? Because an index buys 500 stocks, but the S&P 500 doesn't buy. They don't get $1,000 and then buy one share of each stock. No, they buy at the moment, according to this, 38.8% of the money going into the index go into the top 10 stocks. 38.8% of that $1,000. So you're looking at $3,880 goes into the top 10 stocks, and the rest goes into 490 stocks. So what happens? Well, the big keep getting bigger, right? And not only that, but now that we know that they're getting all the money, we're going to just forget the index. Let's just invest in the Mag 7, which is going to push them up And because that's going up, it's going to push the index. So it causes this positive reinforcement loop or a flywheel where it just keeps feeding on itself and keeps pushing everything higher. So here's what it means to you. This means that the markets could go a lot higher than is practical or rational. You have to just assume that. This is why I struggle. This is why I'm the two-handed economist this year, is that on the one hand, it could do this. On the other hand, it could do that. I hate that. I hate when people do it. But we're at this place where it's really hard to argue. On the one hand, we should be going lower this year. I would say the most we should get is 7-10% on the index. We might see some volatility, which I expect we probably will. But I would say my target for this year is maybe 7 to 10% growth on the index. I think that's kind of reasonable. Now, what could happen? It could go up another 25-30% because there's tons of money going into the index. What could also happen? Well, it could drop another 20% or 30, but then the buying power is going to kick in and people are just going to kick that back up. Look at COVID. The whole global economy shut down for months. Everyone's stuck in their home. They weren't spending money. And yet the stock market ended up for the year. It was like 12% or some crazy number. Like, it was up. The market should have crashed 50% or more. If I had to guess, if you said, oh, this year the whole globe is going to be stuck in their house, they can't spend money, they can't go to work, I would have said that's an 80% correction, like the Great Depression. Like, that would have been my target. Yeah, 80% correction. And if I talk to people without knowing that, they'll be like, yeah, that seems reasonable. What did it go down? Went down 30%. Are you nuts? 30% for that scenario? So my point is, if you can look at that as a very terrible scenario, if you look at 2008, which is really kind of before the relentless bid started, but it was kind of there, but it wasn't as strong as it is now. 2008, we went down 58.5%, and everything went down. And that's because the whole financial system, people didn't know if their cash would be safe. They were pulling out of banks. I mean, it was a mess. So that was a little bit extreme. And I would argue, actually, right now, we're not going to see a financial crisis let me rephrase that. We're not going to see a banking crisis, I don't think, because I don't see it in the cards. It could happen, but the chances of it happening are really low. So I'm not worried about that at the moment. There are things I am worried about, like Japan, worried about them, worried about some other, China, but not worried about our financial crisis or banking crisis hitting again. So if that's the worst case scenario, then you kind of have to take that off the table. Now, obviously, if somebody nukes somebody or we go to World War, okay, well, that's a different scenario. I think that's a low chance of happening as well. So what are the chances? The chances are we see some volatility. Maybe the index drops 20%, freaks people out, and then comes back in. Interest rates, if they go to double digits, we could see a correction of 50% if interest rates go to double digits, but I don't see that in the cards either. I think they're going higher, but I don't think we're hitting double digits. Some really bad stuff would have to happen for that to happen. So, circling back, the relentless bid is basically a huge amount of cash pushing into the markets, pushing asset prices up. What does that mean? That means it's hard to argue that we're going to see a really bad period of time for a long period of time. It's hard to imagine we're going to see Japan. That's what it means. So you could be like me and be practical and look at it and say, this is ridiculous. I can't put money in this market because it's crazy. Or you could realize that, yeah, you make a lot of sense, but it doesn't mean that's reality. And the markets could just keep plugging higher. So you have to keep that in mind. You have to look at that in the bigger picture because things don't always make sense in the markets. Actually, frequently they don't. So understand that the market is much more than just what a company did in their earnings report. It's much more than that. And we don't get to see the belly of the beast because no one shares that, so you don't get to see it. But if you, circling back to this chart, the US, the top 10 stocks have 38.8% of the index. If you look globally, that's actually not anomalous. If you look globally, like Italy, Spain, Singapore, it's like 68, 75%. Switzerland. I mean, these are not, stock markets which are like ours. But if you look at Hong Kong, 67%. If you look at Germany, Germany's 60%. China's 50, almost 60. France, you're looking at 59, close to 59. UK, 48. So most of the world, excluding Japan uh, and India, which is actually weird because there's like one company that makes up most of the Indian stock market. But anyway, um, but I'm surprised to see them lower than us. But point being is it could definitely go higher. Now that means that we have a more inefficient market. It becomes more stagnant. I would trust it less if this happened. I would trust it a lot less. But it does tell you that even though that things don't make sense and they're wrong, it doesn't mean they can't get worse. So just keep that in mind. Don't go, throw all your money under the mattress and go run and hide in the closet because things are expensive. You have to be able to look at both sides and make an informed decision. Say, yes, I realize that things are expensive. I also realize that they could get more expensive. And, if you sit on the sidelines for the next 10 years, you could miss out on a lot of returns, despite the fact that none of it makes any sense. So hopefully I gave you a psychology lesson today. Doug, what chart do you want to look at here? Oh, you're muted, Doug.
Just kidding. I said so. Anyway, I don't know if you, excuse me. Of course, I should stay muted. I don't know if you want to pull up the chart or not, so I'm just going to jump into it. But you were talking about obviously the top heavy, so I thought I'd stick on that because it's just kind of keeps the conversation in one direction. But the top 10 stocks of the S&P 500 gains in 2024. Now, who do you think? What stock do you think powered it all? It's been the hot topic. They've been in the news all the time. Which one do you think was number one in power?
NVIDIA.
Absolutely NVIDIA, 20.4%. Now, number two has been a hot stock and pushing the S&P 500 forever. Which one do you think that one is?
Well, Apple's the biggest.
Apple. There you go. So Apple was number two at 7.8. I won't make you guess the rest. Amazon was number three at 7.3%. Alphabet was 5.7%. And Meta was 5.6%. Do you notice anything in common between all these companies?
They're all tech, Doug.
They're all tech. Now, Amazon would argue they're not tech anymore because there's more to that. And of course, Apple, go away. Got my phone ringing. Apple is is obviously now a manufacturing company, but they're all tech. Here's the thing where it gets very interesting is that the next 17.6% of the performance of the S&P 500's gains, Broadcom. That sounds like tech. Tesla.
Yeah.
That's
a tech company. Yeah.
Kind of tech. Microsoft, Berkshire Hathaway, and Eli Lilly. By the way, Berkshire Hathaway beat the S&P 500 last year for the first time in quite some time. Wow. But Eli Lilly is really, Eli and Berkshire are the only ones that are the real outliers there. So you're looking at the rest of the S&P 500 was 35.6% of the gains. That is exactly 65% of the coverage of the gains for the S&P 500 came from those stocks alone. And interestingly enough, when you look at NVIDIA alone and the impact of that on overall, it was just mind-blowing how much that. The NVIDIA itself contributed to 22% of positive growth for the total return of the S&P 500. Apple was 7.4, Amazon 5.9, Meta 5.5. The worst performers were Intel, which is not a shock to anybody. It was negative 1.3%. Adobe, which we all run off Adobe, which is a little bit of a surprise there. CVS Health and Boeing. The S&P 500 returned 25% in 2024. NVIDIA stock returned 171%. So an incredible influence there. But here's the thing. You have and again, what do we like to do? We like to give our predictions according to what the past did, right? Now, if right now is exactly what I'm going to tell you what to do in 2024. And if I am giving you advice on what to do in 2024, one of the things that I will tell you to do is to consider investing in either President Pelosi. President? Is it president? I can't remember. What is her role in the government? Anyway, Nancy Pelosi, or you can invest in betting against Jim Cramer. There's been some performance metrics that have been tracked throughout the year, and at the end of the day, I am proud to announce that Nancy Pelosi beat shorting Jim Cramer's recommendations. But either one of those, you would have been about a 50% return, which is twice what the S&P 500 did for the year. Inverse Cramer did about 43% growth. Nancy Pelosi, if you just invested in what was publicly noted for where she'd put her money, you would have made 54%. Now, is this going to continue? Absolutely. 100% guaranteed that the past performance is going to be, you're going to achieve it as long as you bet in the past. I have no idea what 2025 is going to be. We're not making any recommendations here, but clearly I think it's a fun way of tracking both what some people would call the legislative insider trading, or they would also say, do the opposite of what is now being published in mass media. So that was interesting. So
Yeah, no, I agree. I think it's a good. I think it's funny. I mean, people have a lot of fun with this. There's actually ETFs out there that track this, and it's hilarious because Jim Cramer is like the whipping boy of anybody who has any sense in the world. I don't know who's actually listening to CNBC, who's actually watching Jim Cramer, but if you are, please stop listening to the show because yeah, I'm not sure we can help you. Like it is like watching corporate media and assuming they're telling you the truth. And
I knew.
I'm not saying Jim Cramer is lying to you, but his job is entertainment. It's not to inform you, it's to entertain you.
Yeah.
And corporate media, their job is to propagandize and brainwash you. That's their job. Because if they don't get you interested by giving you clickbait, then you're not going to stay watching. If you're not watching, they get paid for the advertisers, and around and around it goes. So it ends up being an incestuous circle where they're lying to you. So that's why I don't watch the news, or Cramer. But Pelosi's funny. She does apparently legal, as far as I know, insider trading. It's great to be a politician because you can do insider trading all day long. I think they should be held by the same standards that we are. But we called them out on it, and then 6 months later, they just put it back in another bill and allowed them to do it again. It was totally ridiculous. And Pelosi just needs to be, carted out to a nursing home. We need to get rid of the old boomer generation politicians anyway. They're just corrosive. Get some new blood in there. Forget the party. Just get new blood in there. Get some extras in there. We don't represent anything generally, but anyway, Doug, why don't you wrap us up? We got a minute here. We gotta take us home here.
Absolutely, and I've got something for us to look at next time because again, so we're starting the new presidency. I actually have some data that we can talk about in our next conversation about how different sectors performed under Biden and versus how they performed under Trump the first time around. So it's very interesting for those that might want to join us next time. But for now, what I'm going to lead us to is you want to find more about me. I'm president of Emergent College Advisors. Talk about this week to week. Many people out there, if you've got kids, especially middle school and up, but definitely in high school, you're probably getting more anxious about the cost of college. The cost of college really comes in from twofold. First of all, it's what the price tag is going to be. If you're just going to go into it paying retail prices, I'm going to say shame on you because there's so many opportunities out there for you to get the cost down if you understand how the game is played. That is step one. Step one is reducing the cost you have to pay. Step two is using your money efficiently and not losing money unknowingly and unnecessarily, which comes from being able to be more efficient with the dollars you have. And this is where most people lose money for college. It's not just on the cost of college. You got to start with picking the right schools. You've got to start with understanding how those schools view your kids, who's going to get the money. It's not just looking poor. That seems to be the thing that most people believe. And also, it's not just going into it thinking I make too much money. In fact, if you make more money, you are at the most risk because you're probably going to pay for college with after-tax dollars. Things like tax incentives, things like ways in which you can leverage and capitalize your money. These are the things that that the mass affluent need to know about that can actually make college cheaper. So the second piece is not only the price, but knowing how to pay for college and taking advantage of all the tools and resources available to you. And unfortunately, most people don't know this, leaving not just thousands, but tens and over time, hundreds of thousands of dollars on the table. If you're the kind that doesn't like to lose hundreds of thousands of dollars, it starts with educating yourself. And if you want to learn more about that, go to my website, talk to us, fill out our form, learn right now the scholarships that are available and where that money is. mergentcollegeadvisors.com. Spelling's a little weird, so I'm going to slow it down. MERGENT, mergentcollegeadvisors.com. And if you have any questions, I look forward to speaking with you.
Great. Well, thanks for coming on, Doug. And that's the show for this week. Thanks again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Also, check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a shorting and comment in the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send him an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do.